everyone. Wanted to talk about another way that you can make some sound decisions during this market crash. So I've talked a lot recently, making sure that any cash on the sidelines that you have, great opportunity to buy in at market prices that are substantially lower than they were a couple of months ago. Or if you're already invested, weathering the storm and rebalancing your portfolio, taking advantage of this time, sticking to your long-term plan. Now, one other item that's a huge opportunity right now are Roth conversions. So I've talked about Roth conversions in depth, but real quick here, just a 10, 20-second overview. So a Roth conversion is where you are usually, it makes sense if you're in your first couple of years of retirement, or if you are over 70 years old. This year is a huge opportunity since there's no R&D. But what are you doing? You're taking assets from your IRA. Those are subject to income taxes. And you're taking some of those assets, a portion, and converting them to a Roth IRA. Makes a lot of sense if you can pay 12% in a tax rate today to do a Roth conversion, and 20 years down the road, your future tax rate might be 20, 30, 40%. So if you're going to pay higher taxes in the future, makes a lot of sense to pay a lower tax rate today and get money into a Roth, because those assets in the Roth are going to grow tax-free. They're also going to pass down to your children tax-free. So what would this have looked like had you done a Roth conversion during the 2008-2009 financial crisis? So that's the last time we saw a really substantial market crash. What would that have looked like? So let's assume that you did a $100,000 conversion from your IRA to your Roth IRA. Let's pretend that you did not time this perfectly. So let's just assume that you did this and you didn't time the bottom. You did it, let's say, at the end of 2008, beginning of 2009. So this is a quick S&P 500 graph, macro trend. So I just Googled S&P 500 during 08-09. But in the fall of 08, things got really bad. Now at the end of 08, it wasn't over. In the first 2.5 months of 2009, we still saw a pretty sharp drop. But we're going to assume that our Roth conversion happened right at this time, end of 2008, beginning of 2009. So for the first 2.5 months, we continued to see the market drop further. And in spite of that, let's take a look at what would have happened. So a couple things here. Because a Roth IRA is not taxed, it should not be invested in the same manner as your IRA. What do I mean by that? Your IRA likely is going to be a diversified mix of stocks, bonds, cash, real estate. So your IRA likely going to be some sort of diversified allocation of those asset classes. Your Roth IRA, though, that should not be the same as your IRA. Your Roth IRA has a very different time frame. Your Roth IRA, you're likely, for most of you, you're not going to be touching this Roth for decades. You may never touch it. It will pass down to your children tax-free. So for many of you, your Roth has a very long time frame on it. Because of that, it should be substantially more aggressive. So in this assumption, so we did a $100,000 Roth conversion end of 2008. And let's pretend we diversified across all U.S. company, large cap, small cap. So we have total exposure across the U.S. market and total exposure across the international market. So developed countries, emerging markets, and let's assume we had a 50-50 split, 50% U.S., 50% international. This is also valuable because it shows, in this example, we're not cherry picking the best investments. International and emerging market had a really tough decade from 2010 to 2020. The U.S. markets did substantially better, but it's critical to maintain international exposure. It doesn't necessarily save you from market crashes like we're seeing now, but that's not the purpose. But we'll get into that in a future video. Let's just assume that we all are well diversified across U.S. and international stocks. Your $100,000 Roth conversion that you did back in the middle of the 2008 crash, it would now be worth about $270,000, and that is even with our recent market crash. And so, in spite of the substantial crash we've seen over the last month or so, we are still looking at a 2008 $100,000 Roth conversion that's now worth $270,000. This This Roth conversion, it's also not the end of the story. So if you were 62 years old in 2008, in your first year of retirement, and you did this, well, now you're about 74, and your life expectancy for many of you, you've got a long way to go. So we may have 20 more years of tax-free compounding growth. So this 270,000, it's continuing to experience tax-free compounding growth. And so this is one simple example of how a Roth conversion during a market crash can really be a powerful move. It can pay off in a big way, especially if your tax rate this year is going to be lower than it will potentially be in years to come. And for most oil and gas retirees, if you're in the first few years of retirement, that is your situation. You're likely facing a much smaller tax rate today than you are going to face 20, 30 years down the road. It's not true for all of you, and this does not mean you want to convert all of an IRA. You most likely want to be doing partial, smaller portions of your IRA into a Roth. But it can make a lot of sense, and doing it during a market crash can really pay off in a big way. Let me know if you have any questions, and I've got a whole article on this topic coming out soon.